Welcome, everyone. I'm Joe Galvin, Chief Research Officer at Vistage Worldwide. I'm happy to host the latest webinar in our Peak Performer webinar series. This series is designed to support your leadership climb by bringing the most trusted experts to the Vistage community, experts who provide exceptional insights and best practices, helping you navigate new challenges and possibilities. Today, as we close out 2021 and look ahead to 2022, economic uncertainty is one of the leading challenges facing CEOs. Inflation continues to surge, supply chain issues persist, and wages are rising as the workforce revolution is just getting started. Joining us today to help sort all that out is Vistage member and speaker, Dr. Adrian Cronje, CEO of Balantine, a wealth management firm based in Atlanta and Raleigh. Adrian holds a PhD in macroeconomics and econometrics from Cambridge. He has a list of accomplishments that would consume the balance of our hour if I chose to go through it. He is also the author, along with Robert Balantine, of the just released and soon to be bestseller, First Generation Wealth. It's a must read for all entrepreneurs who are taking the long game and thinking about what it is they're actually creating and what that means. What I love about Adrian's content is that he takes a capital markets perspective of the forces driving our economy today and what that means when we look into the future. Adrian, it's so great to have you back with us again today. Your insights are always so valued. I can't wait to hear what you have to share with us today. So Adrian, let's get started.
Thank you, Joe. Thank you for that very kind introduction. I don't know if it's going to be a bestseller or not, but the book seems to have resonated with so many of our Vistage colleagues, and hopefully we'll have a little bit of time to talk about that towards the end of my session today. I have it on my top shelf, Adrian. So thank you for my copy. Well, you're welcome. We're here today to talk about what the capital markets are telling us about the future economic environment over the next 12 to 18 months. And let's start by setting an agenda to make sure that we can cover all the most important topics that are on your mind before we have a question and answer session. I'm going to spend the bulk of our time together today to talk about the capital market lens that I've been talking to Vistage colleagues about that is so crucial to your understanding about what lies ahead over the next 12 to 18 months. I'm going to talk about three key themes that I believe will drive your business in 2022. And these three themes all tree up to the central issue, which is this. The bottom line up front is 2022 is likely to be all about how quickly interest rates are going to rise. If we have time, I'd like to refer you all to Balantine's Investing Cardinals. As Joe said at the outset, I'm the CEO of a wealth management firm working with entrepreneurs, and I'm often asked during these sessions, thank you, Adrian, you've given me clarity about what to expect from a business perspective, but what should I be doing with my investments? And my answer to that question is the same as always. I don't know, because I don't know your context. Investing without context is an accident waiting to happen. But I did spend some time last year authoring Balantine's Investing Cardinals, partly in homage to a Vistage legend, Red Scott, whose business cardinals many of you may be familiar with. And these are 15 tried and tested axioms about investing that may be helpful to you as you think about positioning your portfolio alongside your business. And then, as Joe said at the outset, I'd be happy to take any questions about the First Generation Wealth book that Robert Balantine and I, Robert's been a longtime Vistage member as well, have authored. It seems to have resonated with so many of you along the way. I will say that during my prepared remarks, I will be referring you to several resources. We have curated those and collated those on a dedicated page on our website, balantine.com/vistage.com. And for your ease of reference, you're able to download them at any time. So let's start with the central theme that the capital markets are trying to digest today, and that is the consequences of overstimulation. You know, Joe, it feels like so much water has passed under the bridge since you and I talked about this back in the spring. And I remember at that time telling you all how the stock, the bond, the credit, and the commodity markets were signaling to us as Vistage members a period of unprecedented economic growth. In fact, I remember comparing what was likely to happen through the bulk of this year and into the first 6 months of next year as the next roaring 20s. a period of economic growth that we have not seen since 1983. Well, since then, the Delta variant has come and gone. Today, we're dealing with the Omicron variant. And I remember also talking to you then about how concerned I was that the consensus about inflation was being way too complacent. We talked back in the spring about the go big or go home attitude that policymakers had taken to the COVID crisis, having learned from the mistakes of the 2008-2009 global financial crisis, where their response was too timid, was incoherent, and didn't arrive in time. Both fiscal and monetary policy makers this time took a big bet, which was to put 3 times as much money back into the economy as the pandemic took out, with a very deliberate bet that they were going to start the economy to recover very strongly to bring down the unemployment rate that had shot sky high in the immediate aftermath of COVID. And so that was one factor that led me to warn you all that the consensus was being way too complacent about inflation. The second factor at the time was being understood, but perhaps is not as well understood as it is today. And that is the supply chain disruptions that so many of us who are running businesses are experiencing as a result of economies reopening and locking down, which has certainly made it very difficult for businesses to access inputs and labor reliably in order to do business. But I also talked at that time about an underreported fact. And that was the very deliberate message that the Federal Reserve sent to all of us back in August of last year, where they really pivoted on their attitude towards how to set interest rates in an appropriate fashion to allow the economy to grow in a sustainable rate. I talked to you all then about how the current chairman, Jay Powell, who has just been reappointed by the Biden administration, said that over the last 10 years prior to COVID, despite their efforts at getting the economy going, inflation had persistently run short of their congressional mandate of 2%. And he said, we're going to take a different attitude. This time, we're not going to take the punch bowl away from the party until we see the whites of inflation's eyes. In fact, we are going to try to let the economy run hotter than usual in order to err on the side of overstimulation rather than understimulation, so that we can get things going again and can get people back to work. Well, guess what? The moment of truth has arrived. Inflation is set to run on an annualized rate of well north of 4% for 2021. Most estimates and the capital market indicators that I'll walk you through show that inflation next year is not going to go away anytime soon. Policymakers have abandoned the pretense that inflation is likely to be quote unquote temporary. They have come used to the fact that it is likely to be sticky. Many markets are beginning to wonder whether the Federal Reserve is beginning to lose its balance on this tightrope of getting the economy going again, but also whether it is going to lose its credibility, or as bond market investors would like to say, have fallen behind the curve, and that they may run risking a policy mistake by not normalizing monetary policy more quickly. And I'm going to show you 2 key indicators today, one within the stock market, but to remind you also of a key metric within the bond market that'll give you all a real-time sense of how the Federal Reserve is able to unravel this particular dilemma. And so inflation is going to be something that we as business owners are going to have to contend with for the next while. And as I said in the spring of last year, there are all sorts of consequences around that and implications we need to think about, not the least of which is proactive pricing power. And Joe, I was so pleased to see that Vistage Resources has stood up the Inflation Center with a variety of different things on this particular topic. As I say, the capital markets are clearly indicating that it is the likely source of when and how quickly interest rates have to go up next year. So before I hit those indicators, I just wanted to remind you all of my key point, which I've been reminding Vistage members of for the last 3 to 4 years. The reason why capital markets are such powerful indicators of the future economic environment is that they are forward-looking indicators of thousands of informed investors and their expectations of their future. And capital market investors' expectations rarely cycle from euphoria through to despondency and back to euphoria in an overnight fashion. We do have so-called black swan events like COVID or the oil price shock or 9/11, but for the most part, expectations cycle over a number of years. And if you look at the data since the Second World War, we should become conditioned to expect a recession twice every 10 years. That's been the post-World War II average of expansions and contractions. Of course, prior to COVID, we were experiencing the longest period of uninterrupted growth that we had experienced since the National Bureau of Economic Research had started collecting data in the 1850s. And so the reason why that is important is capital market indicators are forward-looking indicators. This is in stark contrast to traditional economic forecasting. And it took me 7 years to appreciate this point. As Joe said at the outset, I have a deep passion for economics and its power to explain the world. But as I studied it all the way through to the doctorate level, I became increasingly convinced that its methodology for forecasting the economy over a useful horizon, like 12 to 18 months, which we need as business owners to course correct around our strategic plans, is very, very limited. As I've often said, independent studies have just shown decisively how inadequate consensus economic strategists are at forecasting the future on a 12 to 18-month horizon. It's not that they don't understand how the economies work. It's just that the inputs into their theories tend to be backward-looking and often subject to revision. And so my contention is capital markets lead the economy, not the other way around. And the details of this insight can be found in our recession red lights flashing on our insights page, as well as our Vistage page. And I've enjoyed giving this talk over the years to several Vistage groups across the country. And so my contention is, instead of watching the television or reading the newspaper and relying on traditional economists, you ought to spend a little bit of time understanding 4 key capital market indicators, which will give you a real-time indicator, 12 to 18 months each and every day, as to what's likely to come down the turnpike. And on this particular slide, I'll remind you what these indicators were showing all the way back in the first quarter of 2019. Of course, they flashed red overnight in the first quarter of 2020 as we went into lockdown. And the question before us today, given the key theme of whether we've overstimulated the economy and inflation is likely to become the kryptonite of this cycle, like it always tends to be, because the Federal Reserve has to raise interest rates aggressively or not. And so here is the reason why each and one of these indicators are so powerful about the future. Let's start with the stock market. The stock market is such a powerful lens to think about the future because it gives us a real-time sense of future corporate profitability. There has never been a recession in our economy without corporate profits being in a recession as well. Unfortunately, the logic does not work in reverse. There have been instances of a corporate profits recession that have not resulted in a general economic recession. But when the stock market starts to fall in value in what protagonists in my industry would call a bear market, so perhaps a 20% decline from peak to trough that's sustained over a 3-month period, that's a pretty powerful first clue that stock market investors are thinking that corporate profitability is likely to roll over. Remember, any stock index is just today's profits and future profits discounted to the present by the current level of interest rates. So that's why that's such a powerful indicator of the future. It is not powerful in its own right. And it's important to remember that one always needs to use these 4 indicators in conjunction with each other to construct a mosaic of evidence about what's likely to come down the turnpike 12 to 18 months hence. As Paul Samuelson, the Nobel Prize winning economist, liked to quip, pay attention to the stock market because it's a powerful indicator of profits in the economy in the future, but beware, it is actually forecast 9 of the last 7 recessions. And so it's for that reason that you all need to understand what's the bond market is signaling at the same time. And this is so important, especially in the context of next year, as we all begin to wonder whether the Federal Reserve has made a policy mistake by allowing the party to go on for too long and to allow this sticky inflation that we've experienced this year and on into next year, turning into something more deadly like what we experienced in the 1970s, where the Federal Reserve actually lost their credibility and had to shoot up interest rates to nearly 20% in the early 80s to put the genie back in the bottle. And that is the slope of the yield curve, which is simply jargon for the difference between long-term interest rates and short-term interest rates of bonds of the same credit quality. And this is so important because that yield curve, under normal conditions, when we expect the economy to continue to grow, should be positively sloped. In other words, long-term interest rates should be higher than short-term interest rates. That is a scenario in which the bond market is telling us that the economy is likely to grow, inflation is likely to remain contained, and the Federal Reserve is going to raise interest rates in a slow, measured way in order to make sure that it is calibrated appropriately given where the economy is at. When long-term interest rates and short-term interest rates start to equalize, or where short-term rates start to exceed long-term rates, the yield curve becomes inverted. And that's a particularly pernicious message from the bond market, because when the yield curve becomes inverted, 12 to 18 months hence, over the last 5 decades, a recession has occurred. That is the bond market saying the Federal Reserve has had to increase short-term interest rates very quickly in order to keep inflation down, and they would ultimately have to fall again in order to equilibrate where the economy needs to be. And so an inverted yield curve, 12 to 18 months, is a particularly important sign to take into account. I'm going to show you a chart of how the go big or go home policy 18 months ago really helped to steepen the yield curve, and how in the last few months, the yield curve has decidedly lost its positive slope. Not yet at a point for over concern, but really the bond market is starting to digest whether the Federal Reserve has fallen behind the curve and whether they need to raise interest rates. And of course, this positively sloped yield curve is so important because it is the subsidy that the banking sector receives each day from the Federal Reserve, right? If you think about a positively sloped yield curve, that allows a bank to take in deposits, its source of funding, on low short-term interest rates, and it allows it to lend long, so earning a profit on the interest spread. If the yield curve loses its slope or is negatively shaped, that obviously creates a very significant headwind for the banking system. And so it's through that channel that it's particularly important for us as business owners. The third indicator is the credit market, which is often used as, I would say, a proxy for optimism in the corporate sector. This may not be true of all Vistage companies, but when you think about the larger companies in the United States that are publicly traded, many of them don't just tap the banking sector for their sources of financing. Many of them are able to float bonds, which they have to float at a premium to safe treasury bonds, to finance their activities. So the corporate bond market is an incredibly important market to understand. And what you'll notice, as you'll see in a slide or two, is that the average level at which corporate America needs to float itself from the corporate bond market is a 500 basis point or 5 percentage point premium over safe treasury bonds. And when spreads are narrower than 5%, that's the corporate bond market saying the economy is going to do well. Defaults in the corporate sector are likely to be low because risks are low. But when that premium starts to get through or above 500 basis points, that is a warning sign from the corporate bond market that trouble lies ahead and defaults might be rising. So that's typically the third shoe that drops. And then lastly, the commodity market. And this might seem counterintuitive for us as Vistage members. I don't think many of us do business abroad, but the health of the international economy, and especially China, is something we can no longer afford to ignore. As I've said before, the United States still remains by far and away the most dominant source of global economic growth, but we no longer produce the majority of global GDP. If you add up countries such as China, India, Russia, Brazil, and so forth, and other emerging worlds, they are producing the majority of global GDP. And so it's really, really important, given the amount of commodities that they both produce and consume, for us to pay attention to what commodity markets, and when I say commodity markets, not industrial metals like gold and silver, but commodities that are used in the production of things such as copper, nickel, or iron ore, says about the health of the global economy. And this is particularly important in the context of a strategic relationship between China and the United States that seems to be continuing to deteriorate. It started under the Trump administration with the escalating tariff war, and only really accelerated in its deterioration through COVID. And today there are very serious questions about whether we are not entering a new Cold War with China like we did with Russia back in the 1980s. And so the price of copper is one key indicator that I encourage you all to think about, because it allows us to get a sense of whether the global economy is healthy, because there is the potential that we import weakness from abroad in a way that we have not done in the past. And I've said this quote before, but it's always a healthy reminder. Former Treasury Secretary Larry Summers reminded us of just how important China and the emerging world is in the production and consumption of commodities. He reminds us that in the years of 2010 to 2013, China actually poured more cement than the United States did throughout the 20th century. So the source of instability around the Chinese economy is something we cannot afford to ignore, particularly in the context of a trend that seems to be inexorable over the next few years, and that is towards decarbonization and electrification of transportation. I'm going to show you a slide in a minute or two that shows you how that trend is actually taxing the commodity markets more than many people might think. So there you have it. The stock market, the bond market, the credit market, and the commodity market, used in conjunction with each other, will tell you the signal as to whether the outlook is likely to be strong, fair, or weak. And I'll get to the bottom line. Today, they are signaling dark green across the board. But I want to walk you through a few slides just to show you how far the economy has come, and then dial into those three themes and talk a little bit about what those three themes and the overarching theme of rising interest rates may mean for your business. Again, the resource that might be helpful for you as you listen to this is Are Recessions Red Lights Flashing, which is available on our website at our Insights page, as well as our Vistage page. So let's take a look at the stock market first. It is the area that most people get to see while riding an elevator or watching the news. And what you'll see in this particular slide is I've traced the performance going back to 2009 in dark blue of large cap US companies as measured by the S&P 500 index, and compared that to the performance of the international markets, the MSCI All Country World Index outside of the United States. And a couple of things I want you to take away from this slide, because it reinforces my point, is as follows. Number one, take a look at how smooth the ascent in price appreciation of the stock market was prior to, the last half of 2018 and 2019, where it became more volatile, right? As a reminder, and it's hard to think about what the world felt like prior to the pandemic, the volatility in 2018 and 2019 that led to those yellow indicators that you saw on the previous slide was around whether the Federal Reserve was being too aggressive in raising interest rates. So that should give us a forerunner of what we might be trying to digest next year in terms of volatility as we think about rising interest rates. The stock market at that time was worried that the pace of interest rate increases in 2019 was going to be too aggressive in the context of the tariff war at the time, so undermining corporate profitability. And in fact, in the fourth quarter of 2018, the S&P 500 actually became close to that bear market indicator, having fallen by 19.5% over a period of 3 months. But they quickly recovered as the Federal Reserve at that time was able to orchestrate a U-turn and assuage concerns that they were going to be patient in removing the punch bowl from the party at the time. So So that gives you a sense of how this indicator thinks about issues 12 to 18 months out. Really hasn't been volatile. Take a look at how much the US has outperformed international markets. And the bottom line is US corporations have been able to crank out profits at a much higher rate than the rest of the world. And so that gives you a sense of that dynamic that I described to you. This lens looks at corporate profitability 12 to 18 months out and gives you a sense of what might be coming down the turnpike. Notice also that prior to the shortest and sharpest recession that we experienced, that gray bar, and the gray bars in all my slides denote recessions, it kind of kept you in the game. There were all sorts of reasons to be concerned about the economy. I remember in 2019 defending what the capital markets were saying about the outlook. Many economists and strategists were actually forecasting a recession in 2019. This indicator kept you in the game and allowed you not to be faked out, in an environment that turned out to be positive. And of course, it is today signaling at all-time highs that over the next 12 to 18 months, the economy should continue to grow. Corporate profits, having risen, it looks like by nearly 50% this year, are set to rise by another 10% next year. And the reason for that is something I'm going to touch on in my second key theme, which is how corporations have been able to unleash unusual amounts of productivity growth in order to generate profits. Now, if you'll bear with me, I'm going to try to show you a somewhat colorful slide here because there's a really important thing I want you to notice that's lurking beneath the surface of the stock market today, because it's going to give you a very good real-time sense on how inflation unfolds, how productivity growth unfolds, and frankly, how the virus and the course of the virus, perhaps potentially moving from a pandemic to an endemic issue, unfolds over the next year. And I've traced here the performance of so-called growth stocks versus value stocks, where the performance in green shows growth stocks outperforming value stocks, the performance in blue showing a period where they performed similarly, and a period in red where actually value outperformed growth. And let me tell you why this is such an important insight by first defining what is meant by growth and value. So growth stocks self-evidently tend to be corporations that have had a demonstrated ability to grow their top and bottom line earnings and tend to be profitable. Growth stocks derive a lot of their intrinsic value, not just from profits today, but from profits far into the future. And so when interest rates rise and those future profits have to be discounted to the present, the value of growth stocks decline. Value stocks, on the other hand, are companies that are trading cheaply relative to their fundamentals. Value stocks typically tend to pay out a lot of their total return in dividends and income, and value stocks tend to be concentrated in the areas such as resources, energy, financials, and cyclical companies. And you'll see here that the tail of the tape between growth and value is worth paying attention to. You can see how growth stocks really outperformed from 2017 through to the tail end of last year. In fact, it was round about this time last year that their 3-year trouncing of value stocks really began to turn. And the reason for that is people were starting to think about the potential for interest rates to go up. And so as inflation concerns rise and interest rate concerns rise, there ought to be a tailwind for value to outperform growth. Value started the year incredibly strong. You can see how it drew down and was set for perhaps a multi-year period of outperformance as interest rates and inflation rose, until, of course, in June, the world learned of the Delta variant and there were concerns about the lockdown and going into lockdown again, so ameliorating concerns about interest rates and inflation. And so as the performance of value versus growth goes, so goes the expectations of rising interest rates, rising inflation, and even productivity growth. You would expect productivity growth to help growth stocks over value because the companies are able to generate more with less. And so in addition to thinking about the stock market in an aggregate level, it's easy to track this in real time. You could type into any financial media outlet, the Russell 1000 Value Index or the Russell 1000 Growth Index, and you might expect value outperforming growth to be a signal that the economy is going to continue to open up, that the course of the virus is not going to let us into lockdown, that interest rates may be rising, and that inflation may be rising. On the other hand, if you see growth starting to outperform value, that may be the market surfacing concerns that the outlook for the economy around the virus is perhaps worse than consensus thinks. That means that interest rates and inflation may not have to rise as quickly. So pay attention to that useful indicator. For those of you who are really into stock markets, in purple, I've looked at the valuation between growth and value. And you'll see there that today, the difference in the multiple on value stocks versus growth stocks has not been seen since near the top of the tech bubble that burst in the early 2000s. And so it's a particularly interesting dynamic for investors to face today, but just as important for you as you think about businesses. That spread between value versus growth will give you a good sense of those three key themes of rising inflation, productivity growth, as well as the course of the virus. Let's turn our attention quickly to the slope of the yield curve. This makes the point, going back since the 1980s, that measured as the difference between the 10-year Treasury bond rate and the 2-year Treasury bond rate, if the yield curve inverts or goes below zero, that is a pretty powerful indicator that 12 to 18 months hence, a recession is likely to unfold. You'll notice on this slide that I actually circled in 2019 that the yield curve for a very brief moment in time actually inverted. And if you'll recall the slide I showed you at the outset, not just the stock market, but also the bond market was flashing yellow at the time. And that goes back to the fact that it was at that time that we were thinking that the Federal Reserve was going to raise interest rates too quickly, given the escalating trade war at the time. But you can see there how quickly the yield curve regained its positive slope as the Federal Reserve course corrected and said we were not going to raise interest rates as aggressively. So this slide shows how this indicator in real time can get you a real good sense of whether the Federal Reserve has calibrated policy correctly or not. This zooms in on that particular indicator since January of 2020. And you can see there how the yield curve hadn't lost its positive slope, but is approaching zero on the dawn of the coronavirus crisis. And I remember that Sunday afternoon before markets opened after the Trump administration had put the economy into general lockdown, and watching what was going on in markets, thinking about what this could be like on Monday morning. Was it going to be like it felt during Lehman Day when unexpectedly that great bank went bankrupt? And Chairman Jay Powell that Sunday afternoon said very clearly to all of us, we had learned our lessons from 2008, 2009. We were going to drop interest rates down to zero, even though we'd spent 5 years since 2015 trying to increase them. We are going to use our balance sheet as our weapon of choice. We are going to buy treasury bonds just like we did in the immediate aftermath of the great financial crisis in order to steepen the yield curve. This time, we're not just going to buy treasury bonds, we're going to buy bonds in every area of potential distress during the lockdown. That included state and local municipalities, so municipal bonds, corporate bonds, to the next slide that I'm going to show you about corporate spreads. And guess what? We're not going to promise to raise interest rates or think about raising interest rates until 2023. And you can see there how that set the stage through the summer months for the yield curve to remain positive, and then how in the back half of last year, as the bond market began to discount even more fiscal stimulus under a new administration, peaking at around 160 basis points in May of this year. And you can see how the yield curve has started to slow down or tread water, perhaps even lose its positive slope since then, as the bond market has wrestled whether the Federal Reserve has not perhaps fallen behind the curve and committed a policy mistake by promising to run the economy hot over a short period of time, but so risking letting that lead into a wage inflation spiral that became so difficult for them to defeat in the early 1980s. So pay attention to that, because if you look at this indicator over the long run, today the yield curve is actually positively sloped, but at a level that is the lowest it's ever been before the Federal Reserve has embarked on normalizing policy. So they don't have much room to play with, and their ability to signal to markets that they're going to be able to restore monetary policy, not just by stopping to buy bonds, but raising interest rates slowly, is going to be key to the outlook. Currently, the bond market is discounting a very high probability, a near certainty of at least one interest rate increase by the summer of next year, and perhaps a couple or three more by the end of next year. And so that's a very different cost of financing for all of us than we've become used to over the last 18 months. Credit market spreads tell a similar story. In this particular slide, I've traced in light blue the broad high yield corporate bond sector and measured the interest rates corporations have had to charge as a spread over safe treasury bonds. And you'll see there at 5 percentage points, that's typically where the premium hovers. I've also called out the energy sector here because those credit spreads give you a good sense of where distress is concentrated or not across the broader economy. And you can see there that all the way through 2019, and this is one of those key indicators that led me to take an out of consensus view to economists in 2019, saying that 2019 would be a good year rather than a recession. Spreads remain tight and really blew out in the early parts of the coronavirus lockdown. But as Jay Powell started to signal that they were going to take this area of distress out of the equation by buying corporate bonds, spreads declined rapidly and are today very tightly priced relative to treasury bonds. So that energy trajectory, of course, tells the story of, in addition to an economy-wide lockdown, the OPEC agreement that was not reached in March, which led the oil price to crash, and spreads and distress in that particular sector was acutely felt, but has also subsided since then. Lastly, the commodity market index. And again, I'll stress the point that what I'm looking at here, or encouraging you to look at here, is not the price of precious metals in light blue, but industrial metals in dark blue. And again, the copper price has become known as Dr. Copper for its forecasting prowess of the health of the global economy. So much as I encourage you to think about a bear market in stocks or a 20% decline that is sustained over a 3-month period, any weakness in commodity markets, and particularly in commodity and iron and zinc and so forth, may be a clue that economies like China and the emerging world may be suffering distress. You can see how the industrial metals index has steadily appreciated in the immediate aftermath. Of course, China led us into the lockdown and led us out. And so that's a key indicator to take into account. Net, the bottom line is all 4 indicators are signaling a strong period of economic growth over the last 12 to 18 months. And the resource that you can use to track along with these insights are recession's red lights flashing. Let's turn our attention now to what will drive your business over the next year. Self-evidently, the first most important theme is around inflation. As I said to you today, inflation is tracking to average over 4%, which is twice the Federal Reserve's stated target of 2%. I'm sure that's driven very interesting conversations in your businesses around cost of living adjustments, as it has in mine. The inflation that we're experiencing today look to be stubborn and sticky, as opposed to concerning. But the most important thing that we need to keep an eye on is that inflation expectations remain anchored. Yes, inflation may be sticky and above average, but that remains a stable state for only as long as we all believe the Federal Reserve can orchestrate a normalization of monetary policy in a calm and measured way so that they don't risk losing getting the genie out of the bottle and having to raise interest rates very aggressively in the future. Wages today are running at over 4% wage growth. So there is already evidence of some of this stubborn inflation translating into increases in wages. Incidentally, wages are rising at the bottom end of the labor market by much more than inflation, and at the top end of the market by a lot less than inflation. And so perhaps this is a good thing, because the real wage gap between the bottom end and the top end has, in my view, been one of the proximate causes of how populist politics has become on both sides of the aisle. And so a sustained period of real wage growth narrowing may indeed be a good thing. And there are all sorts of things to discuss around labor market dynamics today. You know, I have a colleague in my Vistage group that runs a large regional staffing company, TRC Staffing, who has described the labor market as experiencing a true black swan event today, unlike anything that company has seen over the last 5 decades. You've got this enormous demand for labor coming from stimulus, and you've got this enormous shortage of supply in labor coming at the top end from the Great Resignation and the immediate aftermath of the COVID, and at the bottom end where people have not been incentivized to actually find work with all the stimulus checks that have been handed out. And so it's a really puzzling conundrum to see more job openings today than there are available workers. And so it's going to be absolutely critical for us to think about how to attract and retain talent. And I'll make a comment about that in a moment or two. I know we've delved deep into that topic on these sessions before, but his view is this is not going away anytime soon. And this inflation labor market dynamic is tied to the second key theme, which I hope this value versus growth index will help you monitor in real time. And that is, what is the productivity growth that we are all going to enjoy from the forced acceleration and adoption of new technologies that has really been accelerated by the pandemic and the post-pandemic world. And here, of course, we're not just talking about our ability to communicate virtually with each other as we are doing today. I am talking about what I see across the entire Vistage network, which is widespread adoption of automation, where companies are doing more with fewer workers. I'm talking about the digitization of our payment system, where we are replacing, cash and so forth with electronic transactions. The power of the blockchain protocol, which underlies cryptocurrency, which is the really big story around Bitcoin, and how that distributed ledger is disintermediating traditional intermediaries. It really is a very, very exciting time for innovation across the economy. And perhaps this is one thing that the authorities were banking on, because as I used to say in 2018 and 2019, the missing piece of the jigsaw in that long expansion was, where had productivity growth gone? It usually constituted around a quarter of our GDP, business investments in the future, and it had been wholly absent for the better part of the decade. Well, creating a high pressure economy, betting on go big or go home, has forced a lot of companies to innovate and to find new and smarter ways to do things. And whether productivity growth picks up next year or not will be a key part of what latitude the Federal Reserve will have to raise interest rates in a more slow and measured way, so that they don't feel like they have their backs against the wall as this sticky inflation turns into a wage price spiral. So really, really important to keep a focus on that. If growth starts to perform in line with value again, that might be a signal that some of this productivity growth has actually arrived and is giving the Federal Reserve more room to maneuver by creating a speed limit for the economy that is higher than it has been in the past, without creating unsustainable inflation. And then lastly, perhaps Bill Gates was right all along. I remember him saying early on that the pathway from COVID-19 to go from a global pandemic to something that's endemic may take 3 years. And as he said at the time, it's all going to depend on our ability to develop a vaccine, but more importantly, to adopt and distribute a vaccine. And so the pathway to something that's more endemic, so that we have these variant flare-ups occurring, but not forcing us into lockdown, is going to depend a lot on our vaccination rates. We've talked about these three key themes at length on the Road to Recovery series, which you can find on our Vistage page. Before delving and double-clicking into a few key implications for your business, let me show you a few charts on each of these three themes. The first is inflation expectations here in dark blue. This is the 10-year break-even rate between inflation-protected bonds and nominal bonds. So what bond market investors think CPI inflation is likely to average at over the next 10 years. And you can see how from the depths of the pandemic in March of 2020, it has steadily risen to well north of 2.5%, which is 50 basis points higher than the 2% target that the Federal Reserve has been assigned. You'll see that the dollar declined pretty tightly in lockstep with rising inflation expectations until about the spring and summer of this year, where they've become somewhat disconnected in recognition that inflation expectations have risen, but also in reality that the US economy has grown at a very robust rate. I wanted to show you a slide courtesy of Barron's about just how the trend of electrification of motor cars is going to tax commodity markets and so create the potential for additional sticky inflation. So this is the metals that Tesla needs to build 20 million cars a year. I believe that's what Elon Musk has committed to doing. And down the left-hand side, I've shown all of the commodities that are required in order to build 20 million Teslas. I've compared the material required to production in 2019 and then compared the two as a percentage of total production. And so a little known fact is, there's more copper today in a Tesla than many of the luxury sedans. And so commodities are going to be an incredibly important part of the trend towards decarbonization and electrification, which may actually be somewhat counterintuitive, but yet another reason why inflation may remain sticky and stubborn for a lot longer than people thought. This slide shows how anemic productivity growth was during the last 10 years and how it started to pick up through the Trump administration's very deliberate pro-growth policies designed to unleash corporate optimism started to make it pick up. Whether that is able to pick back up to the rates we were starting to experience in 2019 and 2020, as I said, is going to give the Federal Reserve potentially room to maneuver and to do things in a more patient way. And we've made the point about just how important vaccination distribution and adoption is going to be in order to keep the economy open. I'm not for 1 minute suggesting that policymakers will resort to the desperate measures of putting the economy into an entire lockdown again, but perhaps the market is starting to sniff out the idea that the Omicron variant, which highly infectious, is actually causing more mild symptoms, is a first clue that coronavirus may be becoming endemic to society, much like the common flu, rather than a pandemic. So those are the three themes. And as I said, those are likely to tree up to the central issue of how interest rates are likely to rise next year. You can use the stock, bond, credit, and commodity market in conjunction with each other each and every day in order to handicap how that's likely to unfold. On our website, you'll have the proxies for how to track that in real time. And of course, there's some clear implications for your business, which I know, Joe, you have discussed at length during your Peak Performer series. I'll call out the issue of supply chain management, where many Vistage companies are now running two supply chains. So adopting a mindset of it's no longer good to have it just in time at the cheapest possible rate, but to have a second supply chain and onshoring jobs so that they can continue to do businesses just in case. We've talked about tech acceleration and what it is likely to mean for productivity growth. How customers have adapted to new buying behaviors. Joe, I know that you did a series on that a couple of months ago. The one area that I continue to focus on, to the point that I made about my Vistage colleagues staffing conversation, is around talent and workforce engagement, and how important culture and flexible time are as tools in not just attracting but retaining talent. Today, with all this accelerated innovation, we have an opportunity to reimagine the workplace with new technology. I think this is an important point that I would like to stress, because I said this in 2019 when my out of consensus view that the economy is likely to be strong held, which is, it's always important to think about the resiliency of your business model and cash flow when times are good. And yes, the economy has grown strongly and looks set to grow pretty robustly over the first 6 months of next year. Now is the time to revisit your conversation and your relationships with all your capital suppliers, whether that is your bank or equity investors, and get credit lines in place for the next downturn so that you can turn the next downturn into an opportunity rather than just a risk mitigation exercise. My hope is that these capital market indicators, by forcing you to look forwards rather than backwards, like many economists will have you, will allow you to prepare your businesses on these dimensions to turn the next downturn into an opportunity. And finally, I will say what I said at the beginning of the year. The single most important advice I can give business owners is to think about their pricing power and their pricing strategy, and to use elevated sticky inflation as aerial cover to continue to raise prices. Vistage speaker Casey Brown is very eloquent on the subject. And it's been rewarding for me to hear so many business owners come back to me saying, Adrian, thank you for that advice. I was able to raise prices early, and often early in the new year, to protect my margins from growing wages and from growing commodity inflation. So I hope that's been helpful to you all. I'm going to end off my prepared remarks by reminding you that you can download the Balantine Investing Cardinals from our website as well. I hope those are helpful to you. Those were done in homage to Red Scott's business cardinals. They are organized around philosophy, strategy, and implementation. And there are tons of resources around each one where you can read what it means. When I say philosophically, your greatest assets have nothing to do with your money, or how important it is to stay in control of your emotions when investing. How, from a strategic standpoint, as I hope you've learned today, capital markets lead the economy, not the other way around. And how, from an implementation standpoint, for example, leverage can be a double-edged sword. A lot of people have found a lot of value in these investing cardinals. Pop onto our website and you can download those and read them in your leisure, at your leisure, as we like to say in the United States. And then finally, as Joe said at the outset, many of you might be interested to read First Generation Wealth. This is a book for entrepreneurs, by entrepreneurs. Robert and I, over the years, have been encouraged by clients and Vistage members to memorialize what we have learned in advising first-generation wealth creators. We in Vistage are so focused on building our business each day and thinking about that as our baby that we don't stop to think about preparing for a transition event. And this book provides 3 principles that you all can consider in order to prepare for a more successful transition, because the data is against us as wealth creators. Fewer than 30% of the time, wealth is transferred successfully to the second generation. Fewer than 12% of the time is it successfully transitioned to the third generation. And all too often, first generation wealth creators go from shirt sleeves to shirt sleeves in 3 generations. And so hopefully the book, which is not intended as a holier than thou self-help book, but a guide to help you prompt questions, will allow you to navigate your own journey more successfully. So with that, Joe, as I call out a reminder of where people can find all the resources, I'm going to turn it back to you. Thank you very much for the opportunity to give an update to the Vistage Network. I've enjoyed it as always.
Well, Adrian, thank you so much. A true masterclass in how the capital markets are really leading the economy. And I think for so many of our members, we also listen frequently to our friends from ITR who are classic economists. And when you put the 2 views together, you both create the presentation of green lights for 2022, and that we should be optimistic about the economic future and spend less time reading the mainstream media on both sides and focus more on informed and educated individuals like yourself. I'd also like to call out the First Generation Wealth book, and it's featured in our Read and Lead network. So we have some comments and some discussions going on there. I invite people to jump in there. So Adrian, we have a few minutes left. I wanted to ask you a few questions. One is, you started by talking about the overstimulation and how inflation is a result of that overstimulation. We've seen over $4 trillion put into our economy, close to $20 trillion worldwide. Build Back Better's on the table. Those can add more. But do you think that we're at the end of this stimulation, and as that is digested, we'll begin to see some of the normalization of what we can expect in terms of inflation and overall economics and the impact of those programs?
Yes, I do. Yes, I do. And there's just so much power in the hands of Senator Manchin today. I think he is leading the charge on reminding both sides of the aisle that inflation has become an issue. And, at some point, all the chickens will come home to roost. And so the big bet is we will stimulate a recovery through all these packages that will be robust and sustained and will allow us to get people back to work in the labor market. A central challenge to the answer to your question, Joe, is whether we're at full employment today already, whether the pre-COVID levels of full employment are actually relevant today, given some of the dislocations in the labor market. And so I think there's a growing recognition that the economy does not need more stimulus fiscally, but much more importantly, that the onus is now on the Federal Reserve to begin to normalize monetary policy, because it's still running at emergency levels when the economy is set to continue to grow robustly.
Can you help me triangulate the data that we heard today in the paper? And for those that are listening on a rebroadcast, it's December 10th, 2021, that inflation came in at 6.8%. You've shown us a number of charts. Can you just kind of put that into a package so we can connect the dots on that?
Yeah, so what you'll notice is inflation through the year has started to accelerate. So the most recent 12-month rate of change in inflation has 6%, which has brought the average up to something north of 4%. And I'm using the CPI headline measure there. Right. So the way in which I think about that is, over the last few months, inflation has come in hotter than expected, and the way in which it has surprised to the upside is accelerating as well. So for the quantitative heads, that means the acceleration in the rate of change is increasing.
So once again, using rate of change data that our friends at ITR like to use.
Yeah, they do. And Alan and Brian have been very good at reminding us at the momentum in economic data. And that's what, they ground their forecasts in. My difference of opinion is that it's better to look at capital market data rather than economic data, as I hope I've been able to convince you of today.
Well, the good news for Vistage members is we get to listen to both of you. Incorporate those expert perspectives and apply that.
Perhaps you can triangulate our forecasts, right?
Yeah, well, we're working on that. I could spend the rest of the day asking you questions, but we don't have any more time. One final question for you, though.
Sure.
What are the warning signs? What are the tripwires that you're looking for, that we should look for, that says these 4 flashing green lights are starting to turn yellow, or pay attention to this?
Yeah. So the first shoe that drops is that bond market indicator. So today, as I think about advising our clients about how to invest, as I think about how to prepare Balantine for the next downturn, are very, very focused on whether that yield curve continues to show a positive slope, which would lead me to conclude that, all things considered, things are going to be fine. But if it starts to lose its slope and capital markets become convinced of the idea that the Federal Reserve has fallen so far behind the curve that they have to raise interest rates very aggressively, that adjustment path is, I think, the path that leads to the next downturn. Inflation is the kryptonite that ends every typical cycle. It's a question of whether it can be sustained and managed. And so for all the reasons I talked about today, it's a real tug of war, and hopefully that yield curve, as well as that value versus growth spread within the stock market, of all the indicators I've talked today, are the 2 areas to focus most on in the coming months.
Well, outstanding, Adrian. Thank you so much for your time and your expertise. We'll check in with you later on next year and see how your thoughts have changed and evolved based on what may or may not happen in the crazy world we live in today. So thank you very much for your time and your expertise today.
You're welcome, Joe. Keep up the great work. You all perform a very valuable service for us as Vistage members. So I'm always grateful for the opportunity.
Thank you, sir. We'll be sending a link to everyone within about 24 hours with recording the slides from today's program. We're going to be taking a little break now for the holidays, but we'll look forward to kicking off 2022 with a big bang. An exclusive conversation with Patrick Lencioni. Members will have access to that on January 7th. Well, he'll dig into his concept of the teamwork trifecta, 3 steps to regenerate your team. So many of us are familiar with this concept around the 5 dysfunctions of the team, as well as his work on the ideal team player. He now fills the gap and connects the dot with this concept of working genius. It's something you don't want to miss, and we are just enjoying the heck out of pulling it together and working with Patrick. On January 21, we look forward to welcoming Shane Foster to discuss 7 steps to reset corporate culture. Culture is one of the few things that you as a CEO can use to control and influence that employee experience. And that's why that's going to be important. You can register for both of those at vistage.com/webinar. That's vistage.com/webinar. I'm Joe Galvin, Chief Research Officer, and I thank you once again for your time and attention. Adrian Cronje from Balantine, thank you, sir. And everyone, please be safe and be well.
Thank you.